Hi guys, it's ETMFX and I'm going to go over 5 things you need to do when you first open the charts. So we're going to start off with checking the volatility. How we do that? We do that through checking our economic calendar. So there's 2 websites that we use. The first one is Forex Factory. So you check the calendar on Forex Factory, and how you check the volatility is through red folders. So as you can see, you have red folders and you have yellow folders. So yellow folders are low impact news. Orange are medium impact news, and red is high impact news. So the reason we look for when volatility is, it's very useful if you are a news trap trader or you're looking to use the news volatility to basically push your price through, let's say, your FTC, or to push you through a supply turn demand zone, etc., etc. Or if you're looking for a quick liquidity grab, as you would trade a news trap, and etc., etc. So how we do that is you look at the currency side, and let's say here you have the Aussie dollar, and at 10:30 it has a red folder. So any pair that crosses with the Aussie dollar around 10:30, you should expect high volatility. Same here, you can see on Tuesday, tomorrow at 10 a.m. USD will have a high impact news. So any pair that crosses with the US dollar will have a high volatility range around 10 a.m. And here you have the reason for the impact, but that's nothing we should worry about yet. This is more advanced. That's if you want to go deeper into like macroeconomics and your overall view of the market, and we can cover that later. But for right now, all you got to do is scout red folders on Forex Factory. The other website is investing.com, and use their economic calendar. And the way you gauge liquidity here is through their star system. So 3 stars is high impact, 1 star is low impact, and 2 stars are medium impact. So now that you know when volatility is going to be present, your second step is to look for if any asset class / pair has a multi-time frame directional bias. So, and we covered that deeply in our higher time frame blueprint course. So first thing, you need a few alignments. So you would want your weekly to be bullish, your daily to be bullish, or your session to be bullish. And as you can check our grading system, and we go over like what's the quality, what's the grade of the trade based on how many multi-time frame alignments there are. So once you have the number of alignments that you would want, or you're comfortable with trading in your strategy, you proceed. So now that we know our bias and we know when the volatility is going to occur, we are looking for a reason to go bullish. We're trying to build some context to add to our case on going bullish. Why go bullish? Because we have our weekly and our daily and our session all aligned to go bullish, which is up. So as you can see, the Friday low got formed. Price came back down on a Sunday. Price came back down, took the low once, came back up, came quickly back up once it touched this area, then came back down again and took them out one more time. So what we know is price trapped the sellers. And you could even say twice, because this is a purge within a purge. Price trapped the sellers. And what happens when sellers get trapped? Price goes the opposite direction. So price came back up, broke structure, gave us our sign of strength, came back down to the 50%. This is the 50% area within this range and this range, and shot back up again. So let's say you wake up and you see price here. We need more reasons to go bullish, even though we already have enough reasons as our bias, as our session, even our session bias, the fact that Friday low got taken out and the sellers got trapped here. As you can see here, we had a supply candle. Price wanted to continue in a compression. As you can see, price really wanted to continue a compression phase right here. And what we mean by that, price wanted to get down low here, come back, use the supply to continue down and maybe even come back here and use this as a RTO to go back up, but it didn't. What happened instead? Price came back down and quickly with strength broke through our supply candle. So what do we know? When supply candle gets broken through a vector phase with a lot of volatility, we know supply turns into demand. So now we have our clues. We're waiting for price to come back down here to eventually do what? Take out these equal highs where the liquidity is. And we're looking for price to come back down to our demand zone and build up and finish above. So now we built our context. We have our backstory, which is we have all the information that we need as far as the bias goes. We built our story where the Friday low's been taken, the seller's been trapped, the sign of strength been shown by breaking the previous resistance that caused the trap, came back down to the 50%. So that's another confirmation. Came back down instead of continuing the compression phase, broke through viciously through our supply candle to come back down to our demand candle. So now we built our scenario, our storyline, our novel, as you can say. We're trying to build a story for price action. And nothing just occurs for no reason. There's a context to everything. So now that we know the story that we're trying to follow, again, you never know for sure if this scenario is going to occur the way you map it out. But having context and having a background information to what previously happened and to what might occur in the future will give your trade a higher probability. Okay, so now that we have our context built, is that enough? Is that everything we need to take a trade? No, we need more confirmations. And how we reach another very powerful confirmation is our ADR, our average daily range. And how we check that is through investing.com/forex-volatility-calculator. So this is the volatility calculator. This is an extremely important step that a lot of people skip. Here you can see how many pips does your pair move on an average. So what I do is you can check 2 days, 2 weeks, 1 week, no more than 54 weeks apparently. So you can only go up to 54 weeks. But what I do is check for the past 4 weeks. I'm trying to gauge the average of a monthly daily range sequence. So here, as you can see, our pair Euro JPY crosses around 111 pips or pips doesn't really matter, per day on an average of the past month, which it doesn't have to be specifically month from the 1st to the 30th or the 29th or whatever. It could just be the past 4 weeks as of today. So the average pips and moves is 111. So what you do, you go back and let's say 645, and you're looking for more clues. So when the average daily range exceeds its average daily range, so let's say on an average it moves 111, but let's say you wake up and you see price at 130. When you see that price exceeded its average daily range, you're looking for a reversal. So let's say right now we check price and the average daily range of today is 140. There is no way you can look for a bullish sequence. Why? Because the low has been formed here and the high is here. So you're looking for price to come back here and continue going up and reaching our liquidity here, which is a part of our scenario structure forming. That would be exceeding your average daily range. And based on historical evidence, which is the ADR, that is more than likely not going to happen. So if you wake up and your average daily range exceeded its average, you're looking for a reversal for price to come back down and finish the day low. Because what is the average daily range? It's the distance from from low to high. This is your daily range. So if it already exceeded its limit, it's not going to continue up and reach this level and even add 15, 20 more pips to its already 140 range, because the average is 111. It's not going to exceed price based on historical data. So let's check what's the average daily range for this pair right now. You grab the low and you grab the high, and you use this tool, the trading view measuring tool. So the average, the range currently is 84 pips. So that the average range, or not the average, I mean the range right now is 84 pips. But our average is 111. So we have still a lot of ground to cover. So that's more reason for us to say price can come back here, react from this area, and continue up and maybe reach this area. And what happens when it reaches this area? It'll be 92 pips. So it still wouldn't even reach our average daily range. So we can take price all the way to its average, which would be right here. And this could be our furthest target. Get it? We're playing out numbers. Trading is a numbers game. As we build the scenario, we're looking for price to cover its average daily range movement. So yeah, if the price exceeded its average daily range, you're looking for a reversal. If the price is still within its range and still has more pips to cover, you're looking for a continuation. So now that we have all the information that we need, our last step is price approachment. We need price to approach our area with two specific ways, which is in a hurry, so let's say with urgency, or in a compression. So let's cover the urgency part real quick. So let's say price is right here. It needs to come down to our demand area extremely fast with urgency. Like it's really in a hurry to get down. So price comes back here, 1, 2, 2, 3 vector candles, and it comes down here. 2, 3, 4, it doesn't really matter, but it needs to come with a strong momentum to our entry and not waste time. Another scenario would be with compression. So compression would be supply, demand, supply, using the supply. So it'll be using the top premium percentage going in a channel. That's the only two ways price can approach our area. Now, what would disqualify this trade completely is if price does this, right? Price consolidates over here, comes back up here, breaks up here, starts messing around, comes back here, comes back, does a lot of foolery between point A to point B. That would disqualify the trade completely. We only have two options. It's either it comes back down in a hurry or through a proper compression. So yeah, guys, I hope everybody liked this lesson, and everybody subscribe, and comment what you want me to cover next. We have a lot of new material coming in, so look forward to a weekly lesson every week, and we're going to open our Telegram group real soon. So it'll be our study group, and we're going to provide a few signals and everything. So get ready.